Hey, what's up, everyone? Logan Freeman here with Midwest CRE Advisors, and welcome back to Market Signal. Let me ask you a question. Has Goldilocks finally left the building? For the past year, markets have been dominated by one phrase: higher for longer. The idea that interest rates weren't coming down anytime soon, no matter what the economy did. But this week, something shifted. Before we talk about what that means for commercial real estate, let's take a step back. In financial markets, Goldilocks describes an environment where the economy isn't too hot and isn't too cold. Weak data pushes rates lower, and ironically, markets rally. Bad news becomes good news. And honestly, we've had plenty of weak signals lately. Housing sentiment has struggled. Job growth hasn't exactly impressed. Consumer confidence has felt shaky, yet rates stayed high. Until now. Earlier this week, Treasury yields dropped sharply, while stock markets pushed to new highs. That combination doesn't happen often, and when it does, it usually signals a shift in how investors are thinking. So, what changed? Retail sales came in weaker than expected. Markets were positioned for growth, and instead, they got flat numbers. That was enough to move bonds. And when bonds move, commercial real estate pays attention. Now, is this a true turning point? We don't know yet. There are still big data releases ahead: inflation numbers, producer prices, corporate earnings, jobs data. Each one has the power to confirm or completely change the narrative. But let's talk about what this could mean if rates really start trending lower, because this is where things get interesting for CRE. Transaction volume has already been slowly improving. Deals are starting to come back to life. But sustained lower borrowing costs could unlock a whole new level of activity. Deals that didn't pencil start penciling again. Capital that's been sitting on the sidelines starts moving. Developers regain confidence, and momentum builds fast. The commercial real estate market doesn't move slowly once it turns. It moves all at once. Nobody wants to stand around watching paint dry. If rates continue to fall, investors are going to act. Operators are going to act. Developers are going to act. So the real question isn't whether CRE accelerates. It's whether higher for longer has truly left the building. It might be too early to call it. But if this is the beginning of a shift, the next phase of the cycle could move faster than most people expect. I'm Logan Freeman with Midwest CRE Advisors, and this has been Market Signal. If you want real-time insight into how macro trends are shaping commercial real estate across the Midwest, make sure you're subscribed, and I'll see you on the next one.